Hi, this is Chuck Oliver. Welcome to this week's Taxes Saved Case of the Week. Well, this is an exciting one, Davis and I have for you, where we're showing the long-term tax benefit, right? The negative compounding effect or the positive compounding effect, depending on how you look at it. If it's tax-free, it's a positive compounding effect. If it's tax deferred, it's a negative, right? So let's jump into it, Davis.
Yeah, this is an exciting one. It's a sequel to last week where we talked about a new strategy, Dad, the 6X software strategy that a lot of clients are new to that I know you're just getting to experience this year, but it is a great one that gives great benefits as well as some business benefits and overall cash return. But to remind people from last week, I'll pull up the return and the ROI that we achieved just in last year's first year tax savings, the deduction provided alone. So give me 1 second here and everyone should be seeing it on my screen, right? So here we have W-2 uh, overall income, right? And then we also have some interest and dividend income, but the big thing here was this client did $130,000 of Roth conversion, and they used up first year 80,000 of overall tax savings in the state of Colorado, right? And this year we're going to help them do more Roth conversion. So in 2 years, they achieved 140% return on tax from the 71 grand they outlaid to get the $105,000 of overall tax savings in a 2 year fashion, right? So if 148% is a good return, Dad, as you know, that first and foremost, numbers each year need to make sense for the conversion a client does with the strategy they employ. But the real benefit, as you know, is this power, like you said, of this compounding interest, right? So today we're really going to dive into that and really the idea that you don't want to wait. You need a plan. You need to get money converted. Not that we feel that, it's really the math that's going to show you that, right? The power of compounding interest. And so I'll go ahead and show you this. This client was younger, right? This compounding effect really is playing a fact for him. His RMD is not till required minimum distribution is not till age 75, right? But he's age 50. He's a business owner that he feels he's really going to grow his income, and that's something that he's really focused on, right? So with that, right, by saving these tax accounts, what he has, the 1.2 million he's worked hard and saved hard for him and his wife, he's also done really well on the growth of this money, right, in these tax deferred accounts. And so, for him, he's in some gold and silver and some other things that have done really well and will continue probably to do well, as well as just his overall alternatives he has with us. And so he's doing at least very conservatively about 10% per year. And we've been showing account expense, assuming someone's managing this money of some magnitude, and we'll push that at about 1%, right? So really a net nine after fees and expenses. So here, then we give where his tax rate stands today marginally, right? That 24% tax rate, most likely under these variables, right, is very conservative, right? So how long is this money compounding for? How long is it going out? And that's going out for age 90. So 40 years of compounding on this money. RMD doesn't come until age 75 though, so not for another 25 years. This 1.2 million he's amassed today, growing at 9%, taxed at a 24% as he takes that money out for his RMD, or in other words, the government forces him to take it out, right? So
Yeah.
those are our variables. Go ahead, Dad.
Yeah, share. I was going to say, share with them the future RMD, the power of negative compounding, right? Is
Yeah.
people don't understand this will permanently tax his Medicare, this will permanently tax his Social Security up to 85% of it, and will leave a massive tax burden. But just look at what his required distribution is real quickly there, Davis.
Yeah, yeah. So go past the ugly numbers to get to one of the first ugly numbers. And you see here, right? 1.2 turns into 1.308, but over 20 plus years, you're looking at about $9.5 million, close to 10.3 and some change. And you can see there his first RMD is about 420 grand. But after tax is given 100 grand to Uncle Sam, conservatively. I would hope that I'm sure you would hope too, for ourselves and other clients that tax rates are only 24% over the
Yeah,
next 25 years, right? That
that'll
is,
be a gift.
it'd
That'll
be
be
an
a gift.
absolute gift. So here you can see, right, the ugly numbers, right? Just from the RMDs, the forced distribution the government forces him to take out at age 75 here till age 90, he'll pay just in tax cumulative of $3.2 million, right? Remember, he only has 1.2 million. Not only, it's a great amount for a 50-year-old in tax deferred that he's worked hard and saved hard for, but literally almost three times the amount he has there today, he'll pay in RMD taxes alone over 15 years. And then a lot of clients, they have mixed opinions on this. Obviously doing what we do, we see clients of all facets paying different types of tax and using of these RMDs. But the biggest thing that always surprises me is how frugal the current generation is with their what they worked hard and saved hard for. They don't really need to spend the RMD. So what we commonly see is them reinvesting that required minimum distribution. And so what this second row is showing here of 1.8, almost basically 1.9 million of tax, is the client not needing it and reinvesting it, right? So that can be skewed for some, but commonly we do see it, as you know, Dad, all the time that clients are reinvesting this and getting hit with tax again on that brokerage account or, CD they throw that money into.
Yeah.
So right there, 1.9 million. And then this client, very legacy focused. It's probably the biggest impetus of why he's really looking to Roth convert this money and get it tax free, not just for himself, but some of the worst tax we see, as you know, Dad, is this legacy tax, right? And so if he didn't do any conversion here, obviously we had a plan he did here, right? You can see his legacy will have 10 years to spend down these tax deferred accounts, and his kid's doing really, really well, right? His legacy already, right? They're just coming out of college already with high paying jobs and looking to progress that. Right there, they're gonna have 10 years to spend it down. It's gonna be all taxed at age 90 when he passes in this analysis to his kids, about 4.1 million of legacy tax he leaves them. So all in, right? We're looking at 9.2 and change of total tax, no conversion plan for him at all. Right. And again, we can ignore the right because we definitely don't believe in the right, right? That's just saying, hey, rip the band-aid off, which would be false because you're definitely not paying 24% tax to Roth convert, again, 1.2 million today. We use strategy and planning over a time frame and process with proper strategy to offset the tax that you would pay to do the Roth conversion, right? It's a big difference than what any of this is saying here. We don't support any of this, but what we did for this client, to remind you, last year with the 6X tax deduction, he Roth converted 130 grand. Right. So what we're about to show you is the long-term ROI by, might not seem a lot, but 130 grand out of his IRA. How much did it save him of this $9.2 million of tax for himself over RMDs to age 90 and his legacy at age 90 inheriting this tax? All right. So this will be why we tell you not to wait. Right? So same analysis, just 130 grand and $539 less to be to the penny, right? And same growth rate, same account expense, and even same tax rate. But what did it do to his long-term taxes? Look at this. Literally $1 million of long-term lifetime taxes saved for himself and his legacy. If he went from 9.2 to 8.2 and change. And that is really, as you know, Dad, why the power of compounding tax deferred compared to tax free in a Roth, it's worth not to wait.
Yeah, I mean, you think about it, it's almost a 10x of just long-term tax savings. So this is where, again, this great wealth transfer, which I'm working on a book as we speak, is 124 trillion is going to change hands over the next 20 years. So we have a number of you that have reached out saying, wow, my dad, my mom, they're a widower, they got widow tax penalty or widower tax penalty, or my mom and dad are really fed up with their required minimum distributions. And I know that we're going to inherit something because just as Davis alluded to, certain generations that still have pensions, Social Security may not have, right, the need to spend their required minimum distribution is just compounding and reinvesting and causing more tax havoc. As a result of that, go to taxessave.com, right? That's taxessave.com. Avoid this 420 dropped only like 50 grand down to 370, we'll call it 370, about 40 grand drop in the RMD by the time he has to take them. And as somebody said to Davis and I the other day, like, well, I think I'm just going to spend my RMD. Well, you can spend an RMD or you can have a Roth IRA that doesn't require an RMD. And if you're going to spend, why not spend tax free? So whether it's somebody like this particular client referring his parents in their 70s and 80s, or clients in their 70s and 80s referring their adult kids in their 40s and 50s, folks, it's never too early. It's never too early. It's never too late to get a head start to be tax strategy smart. And by going to taxessave.com, not only can you go to the middle of that screen, but I want to have you watch at the very beginning when you log in, there's a red square with a white arrow. Click it within seconds. At your fingertips are tax savings opportunities of case studies, and then scroll all the way to the bottom and take us up on learning the tax risk road that you're on, right? It's a complementary analysis, a saving tax optimization plan analysis for that matter, that we run that with you. And there's a place to go right into the calendar, request that time. And I will say the opportunities, the inventory, Folks, it's this is the time of the year where things really start for people to get serious about this. And some of these things aren't going to be here forever, right? This six times deduction is only here for another roughly month. Then it goes back to a five times deduction. That's a motivation for people to not put this off way late in the fourth quarter to reward people that are being more proactive. And we've had a number of you that have really liked learning that strategy. So go to taxessave.com. That's taxessave.com and learn what you can do both short term, long term. You don't have to be self employed. If you're a high income W 2, maybe you're a high income retiree, maybe you're just a heavy saver, IRA, 401k person, self employed or not, the strategies can be implemented and it's not too late, folks. You work really hard for your money. Learn how to make your money work harder for you. And for those of you that are in that retirement red zone I talk about all the time, within that 5 years of retirement or just 5 years into retirement, you do not want to delay this, folks. Redirecting this money back into your budget either moves that needle to retire sooner or gives you more cash flow, right, to retire and travel more and kind of be in your go-go years and then still be able to not just live more tax-free, but leave more tax-free. Taxessaved.com, taxessaved.com.